Consistency is run by a bunch of investment bankers, and their modus operandi help make it.
Hello, I'm Fernando Luque, editor for Morningstar, and today we are going to talk about one very attractive and very original fund called the UBAM Europe Equity Dividend Plus. And I'm joined today by the two managers of the fund, Scott Meach and Rupert Welcome. Thank you very much for being here.
Thank you.
Well, my first question is, the fund has the objective of distributing a 10% gross dividend per year, which is more or less 2.5% quarterly. Well, that's a lot. How will you get this objective? What is the strategy of the fund?
Okay. Well, I think some observations about the market at the moment which lead us to be able to deliver that. Firstly, we see a fantastic opportunity for investing in equity dividends at the moment. Equities yield more than bonds. Equities yield more than single A corporate bonds by a good margin, 200 basis points. So we like the attraction of that 5% yield that we can see at the moment. But also the other feature of equities is the volatility at the moment. So this product targets a 10% return. 5% of that comes from the dividends from the companies in the portfolio. So it's a simple portfolio of 22 stocks with very strong characteristics that will pay a dividend going forward. And then we take the volatility and we use the option market by writing call premium, selling calls on the underlying securities in a very systematic way. And then when we do that, we get a lot of call premium, and we can add to the 5% from the equity portfolio another 5% from the call premium to give you your 10% return. But also we've created a portfolio in doing so that has very low volatility characteristics as well.
Yeah. Well, to be correct, the fund has, the option to distribute this dividend or to reinvest this dividend.
Okay.
Because I think
yes.
You have an accumulation class. No?
That's correct. Yes. So the 10% distribution will come every quarter. So there will be a 2.5% every quarter of the year, and there are two classes of fund, as you say. So you can reinvest or you can receive your distribution.
One technical question: is that dividend guaranteed, or does that dividend depend on the market conditions?
Sure. It's we haven't made it as strong a promise as to guarantee it. We're very confident of delivering 10%, but the way to look at the distribution is more like a bond. So the starting NAV of the product is €100, and in its first year we'll pay 10, so we'll pay 2.5 every quarter. And if you think of it as a coupon on a bond in that way, then I think looking forward, if the market rises or falls, that's what we would hope to repeat every single year. Yeah. But it's not a promise because it's an equity product, and good things and bad things sometimes happen in equities. But we're very confident that we can get there, and it'll be a board decision to pay that distribution, and that certainly will be paid this year.
Yeah, you mentioned the similarity with the bond. Does that mean that the fund will have lower volatility than traditional equity funds?
Absolutely, yes. So if you look at the equity portfolio that we've selected, and we can talk more about that in a moment, just as an equity portfolio it would have a 0.7 beta. So it's a very secure list of companies with no financials or utilities in the mix. When we add the call option overlay, we're obviously giving up a lot of the upside for the individual stocks, but we're generating a lot of consistent premium every month. So when we add that, we're getting a beta of about 0.3 to 0.4. So you've got a very low, much lower correlation with equities. Yes.
Well, Rupert, let's examine the second part of the strategy, which is the stock selection. How do you identify sustainable companies that pay sustainable dividends?
Sure, absolutely. Well, we use two different techniques. The first thing that we use, which we use in our main fund as well, a long-only fund, is to use a quantitative strategy, a quantitative screen, to filter a very large universe of about 1,200 stocks that we think the Pan-European Index represents. We take that list down to a usable number of stocks with this fund by excluding all those stocks that have cut their dividends by more than 50% per annum in the last at any stage in the last 10 years. So that actually cuts out quite a lot of stocks. We then add another exclusion criteria, which is that we want all stocks to have their dividend covered by more than 1.5 times by earnings as well. And that leaves us with about 120 stocks. We then use our qualitative analysis to take that list and choose the best stocks. What we're looking for is the sustainability of the dividends. We're not looking for the highest dividend payers in the index. We're looking for those that have a strategy and a business which allows them to pay that dividend year in, year out, and hopefully add some growth to that as well. We're also looking for management that we think have the kind of strategy which allows for that continuation, where the strategy is persistent for a number of years, where they're investing their cash sensibly and in a disciplined fashion, allowing for that growth to continue without the sort of boom and bust you have in some equities. So we meet a lot of companies. Last year, as a team of 4, we met 250 companies, and we spent a lot of time talking over that strategy and getting comfortable with the kind of companies which we could invest in. So for this strategy, we have 22 stocks in the fund, and then we have a reserve list of about another 30 as well, coming from a huge universe of 1,200 stocks.
Yeah, well, it's quite a concentrated fund in terms of portfolio. Could you give us a couple of names that meet your criteria?
Yeah, for sure. The first name I would highlight would be Total, the French integrated oil play. It has a running yield, dividend yield of well over 5.5% at the moment, with some forecast dividend growth going forward. Throughout all the periods with different, over the last 10 years, with different levels of the oil price, this is a company that has managed to just gently grow its dividend. So we like that kind of company. It shows the resilience over time, and it's perfect for this kind of product. The second example I give would be the Swiss pharmaceutical company Roche. Now, if you tried to put that into an income fund 5 years ago, you'd have had difficulty because the yield was only 1 or 1.5%. But it spent the last 5 years growing that dividend quite fast, and there's been an overt strategy by the company, and it now yields around 4%. And yet, we think this still has exciting growth as a company, and the dividend is extremely well covered. So they're 2 very large companies with very sustainable dividend profiles.
One last question, Rupert. Why is the fund focused on European companies? Why not extend the universe to global companies or US companies?
Well, there are a number of different reasons we could go into, but there are 2 particular ones, and I think your question would be why not have US companies in there, for example. And the US corporate environment doesn't have the same culture that Europe does of paying dividends. They're much keener on buybacks, and actually the S&P 500 dividend yield is much lower than the MSCI Pan-European Index, for example. The second is, so on the contrast of that, the UK and Europe generally, managements have a desire to pay an ongoing dividend, and certainly we find that some of the most attractive companies throughout the globe and the best opportunities lie in Europe.
And the dividend yield for Europe is higher than for the US?
Yes, it's currently running at about 5% for the MSCI Pan-Europe as a whole.
Yeah. Okay, excellent. Well, Scott, Robert, thank you very much for presenting this new strategy to our audience. Thank you very much.
Thank you very much as well.
Having us.
Run by investment bankers, and Morningstar's total help make